Now, here is Ticky Fullerton on Your Money.
Welcome to Ticky. I'm Adam Creighton, of course, filling in for Ticky Fullerton, and here to bring you a full hour of the very best in business coverage across the nation and internationally, especially where business and politics meet. And coming up today, well, how changes to the legal system may prevent ongoing misconduct in the financial services sector. Well, Aleks Vickovich from yourmoney.com.au speaks with academic David Millhouse on his powerful university thesis and his blighted past as a former company director. And unions and super funds flexing their muscles on wages. We're going to hear from Ticky Fullerton, who speaks to former Minister for Superannuation Nick Sherry. And should central bankers and governments bow to populist pressure? Well, my interview with Gabriel Sterne from Oxford Economics a little later in the show. But moving first to the Hayne Royal Commission, and of course one conclusion that was made by Commissioner Kenneth Hayne in his final report a few months ago was that much of the misconduct that has occurred within the financial services sector can be traced back to flaws in the legal system. Well, David Millhouse, who received a PhD at Bond University for his thesis on the systemic and cultural failures in Australian financial services, has a few recommendations on how the law can be reformed to prevent recurring misconduct in the sector. Well, for more now on this, I'm pleased to welcome editor of yourmoney.com.au, Aleks Vickovich, to the desk. Alex, thanks for joining us. Now, look, of all of the recommendations that David made, what really stuck out for you as the most interesting or maybe the most crazy? Yeah,
well, not too long ago, Adam, you know, a doctoral thesis on financial services law, probably unlikely to get much airtime. Of course, this issue is now on the front pages, and rightly so, as we look towards the election and exactly, you know, how the next government, whoever that might be, implements the Hayne recommendations. David Millhouse is an interesting guy. He's a venture capitalist and private equity investor by background, and he's done this thesis. He has some very strong views on what exactly we should be focusing on when it comes to the Hayne Royal Commission and also previous inquiries that we've had. He says there's a bit too much focus on Hayne's recommendations, which he says are just sort of tactical, piecemeal responses. He says we need to go a lot deeper and have a lot more holistic reform. Now, when you consider that both political parties are already starting to sort of distance themselves from the 76 recommendations that Hayne has put forward, I wonder whether there really is that, you know, appetite for that kind of widespread reform. In terms of your question on the specifics, one thing that he really is pushing is this idea of a fiduciary duty. And this is really important because I think most financial services executives will tell you that we already have one in Australia in the future of financial advice reforms. Now, what Bill Shorten, as Minister for Financial Services at the time, introduced was a best interest duty. And the industry talks about this as being interchangeable with a fiduciary duty. Dr. David Millhouse, however, says not quite the same thing.
Now, just in terms of David Millhouse's background, it seems that he actually has some first-hand experience of misconduct. He was involved in some way in the Trio disaster?
Yeah, that's right. So he did enter an enforceable undertaking in 2013 with APRA, and that relates to, and subsequently they also were trying to, APRA was trying to seek orders to have him removed and banned as a superannuation trustee, which they subsequently withdrew. He says he wasn't a director of APRA and that APRA is a director of Trio, rather, and that APRA is lumping him in here. You know, and so there is a moot point there. But he did enter this EU, and he does candidly say that his experience as part of this collapse and what ultimately happened with that case really did inspire the research that he went on to do.
And of course, the mortgage broker issue, as you know, at the moment is a really hot topic. One of the recommendations from Hayne was to make customers pay up front. Did he have anything to say about that in particular?
No, but I think, you know, it's interesting that you know, the mortgage brokers have clearly run a successful lobbying campaign since the final report came out. He has a lot to say about lobbying and the influence that these sorts of business representatives have on the laws that he says are not in the public interest. So I think people are looking at David Millhouse's thesis and are being a little bit emboldened about the lobbying that might be to come.
Well, just in terms of this thesis, has he sent it to APRA? Has he sent it to ASIC? I mean, does he really think it's going to get traction with the political class?
Well, look, it may do. And, of course, one of the reasons that it might is this Trio Capital thing, which continues to rear its head. Now, for those that aren't fully across this, you know, this is described by a parliamentary committee as the largest superannuation fraud in Australian history. There are a great number of investors who still haven't been compensated in any way. And Bill Shorten himself has a personal connection to this because, of course, he was the minister at the time. And a lot of the investors who lost money in the collapse of Trio and the underlying funds blamed him for not compensating SMSF investors, in their view, in the same way that the APRA regulated fund members were. So this whole Trio collapse really did become a front on the culture wars in financial services and in super. And that issue's certainly not going away anytime soon.
Okay, Aleks, thank you so much for coming on, and let's go right now to that interview with David Millhouse.
Dr. David Millhouse, thank you for joining us. You've been very busy in the last few years conducting some fairly extensive research into what you call systemic and cyclical failure in the financial sector. Obviously, that's a topic that has become more topical in the last 12 months or so by way of the Royal Commission. So firstly, what exactly do you mean by financial product failure? And can you give us a sense of the scale of the problem?
Well, I certainly, Aleks, and thank you for having me here, but I've spent the last 5 years studying court judgments from all of the senior courts across the country in what I've categorised as non-bank financial entities. So that's quite a wide-ranging group, and it does include the wealth management parts of the banks. And what I was interested to find out, given that it's not just the Hayne Royal Commission, but also the Productivity Commission and the Hayden Royal Commission and others, including parliamentary inquiries, what I was really anxious to find out is the scale of the problem and the underlying legal reasons as to how Australian investors and beneficiaries have been so badly afflicted. So it's been taking what is a massive amount of unstructured information and converting it into structured empirical data upon which future policy can be based. So, as I say, it's been a labour of love, Aleks, for this last 5 years, and really what I think are some very, very significant findings, and the conclusions are very sympathetic with those of Dyson Heydon and Kenneth Hayne, and that is that we do have systemic problem in Australian law, in financial products and financial services. We've to date tried to address those by accretive statutory change across a whole range of statutes, but the underlying problems are deeper than that. And Hayne actually gets to it on page 494 to 496 of volume 1 of his final report. And that is the need to simplify the law and ensure that all in the investment chain focus on the intent of the law and not just box-ticking compliance, which today is what we have.
So you mentioned there Kenneth Hayne's views on the systemic problems, but famously, of course, in his interim report, the Royal Commissioner also said that we need to focus on enforcing the laws that already exist. In your thesis, David, you seem to suggest that there are weaknesses in the law as it is at the moment, which has directly led to investor losses or product failure or indeed misconduct. So is Kenneth Hayne wrong on that?
Well, Hayne's report and his recommendations are really in two parts. A lot of the disappointment that you see reported publicly on Hayne is to do with the recommendations, which for the most part are tactical. But the real message that he has is that there is an underlying cultural problem, and he talks specifically about the need of the confluence between law and morality. And in fact, Dyson Heydon in his Royal Commission report came to the similar conclusion, where he talks about culture and taint and the diffusion of unhealthy culture across the whole financial sector. So what Hayne specifically says is that the bigger challenge, which is the simplification of the law and focusing on the intent of the law to meet community expectations and norms is such a large job that the specific tactical recommendations should not have to wait until that job is completed or even commenced. And I would hope that the research that I can contribute to the community is, and particularly the empirical basis of it, is the start of that process.
So just on that more cultural front, you take aim specifically at our approach to financial regulation. You say, David, that this is impeding Australia's goal to become a true global financial centre. What do you mean by that?
Well, in many respects, Australia is an outlier when it comes to its financial sector regulation compared with other jurisdictions. And this has been the subject in part of quite a lot of research from Mark Johnson, for instance, who did two research reports going back to 2009 as to how Australia can become a world financial centre. The problem with that is that both for the export of Australian financial products and for the import of foreign capital, particularly to our SME sector, that the law has significant disconsonances and impediments to those two processes. Now, in part, this is being addressed in the new Part 8, Chapter Part A and B of the Corporations Act, which permits some Australian products to be exported to other Southeast Asian countries and vice versa. That's really only the start of a process. But Australia has this enigma in the use of its trust structures, particularly for collective investment schemes. And I know of fund managers, for instance, in London, that will not invest in such devices because since the advent of the Managed Investment Acts in 1998, we've effectively destroyed the separation between trustee and promoter. So, you know, people around the world, in my experience, have called this the poacher gamekeeper model in Australia, where there's not the separation of power and it leads directly to conflicts of interest and conflicts of duty.
So you say that we are
dealing with these related parties.
You say, David, that we are behind our global peers on that particular issue. You yourself, of course, have some first-hand experience of the pointier end of the regulatory system. You entered an enforceable undertaking with APRA in 2013 relating to what the prudential regulator says was your directorship of the now defunct Trio Capital. How has that experience influenced your perspective on these issues and indeed your subsequent research?
Well, it was certainly one of the triggers to commence this research back in 2013. To be clear, crystal clear, I have never been a director of anything called Trio Capital or anything called Trio. I was certainly a director of Tolhurst Group in 2003, which became Astara Group in 2004, and I actually left the board of that entity in mid-05, having written a 5-page memorandum to the directors, the other directors, complaining about corporate governance standards and related party transactions in particular. So I was, as I say, never involved in what happened with what then became Trio many years later and many boards of directors later.
And in terms of the problems, David, that entity ultimately came to experience, do you say that that is part of these systemic and cyclical problems in the system rather than mismanagement of those funds or indeed personal greed? Were the investors that lost money in Trio a victim of these systemic problems?
Well, I think there were definitely systemic problems that occurred in Trio being effectively a conglomerate of financial services businesses. And it was not alone. There are many, many others. And if you look at the empirical data, a good part of the investor losses have been because of those conglomerates, which often are a mix of managed investment schemes and other funds management businesses. They often have superannuation business entities in them. And AIIA, I note, says that if you're a superannuation trustee, then that is all you do, and rightly so. What he doesn't specifically say is that the directors of that corporate trustee also have that constraint. So he started the process of looking at this process of vertical integration and conglomerate integration of various financial sector businesses. And many of them include everybody pretty much that's involved in the investment chain. So what you have to do, where we have to head, is quality assurance of the investment chain. And fundamental to that is defining who is a fiduciary in that chain and what those duties are, and as part of the process of eliminating conflicts of interest and duty, often derived from related parties in those entities.
Well, we're heading into an election cycle, of course, David. You've called for more holistic reform and not a piecemeal approach. We'll have to see whether your research gets picked up and whether indeed our policymakers have the appetite for that kind of reform. Thank you for your time.
Thank you very much, Alex.
And that was David Millhouse there speaking to Your Money's Aleks Vickovich. Well, time for a short break now, but after that, should super funds pressure companies to increase wages for workers? Well, we're going to have Ticky Fullerton's interview with former Minister for Super Nick Sherry next.
You're watching Ticky on Your Money. Now, back to Ticky.
Welcome back to Ticky. Well, business chiefs are lining up to lash Labor's plan to drive up wages. Now, that's amid revelations that the ACTU will hold nationwide anti-coalition protests during the federal election campaign. Well, tens of thousands of workers are expected to walk off the job on the 10th of April. Now, this comes after a meeting of the ACTU executive in Melbourne, where a resolution was passed calling on workers to join the capital city protests next month. Well, industry super has also been dragged into the wages debate. Now, one of the big topics at this week's AICD Governance Summits in Sydney was ESG activism by shareholders of large companies. And of course, industry super funds are especially in the spotlight, with over $630 billion in funds under management and of course strong connections with the union movement. Well, we saw Australian Super Chair Heather Ridout defend her organisation's methods of pressuring companies to overhaul their operations based on ESG concerns. So the question is it right for super funds to pressure companies into raising wages? Well, Ticky Fullerton sat down with former Superannuation Minister and, of course, now Chairman of Household Capital, Nick Sherry, a short time ago. And they began by discussing Household Capital's new retirement product, which gives retirees access to equity within the family home.
Nick Sherry, nice to talk now. I think the last time I interviewed you was back when you were Minister for Superannuation, and you've really been in this sector since then.
Yes, well, 86, it's over 30 years, not just in Australia. I've done a lot of work on the design and operation of systems in other countries, UK, Ireland and elsewhere. So it's a fascinating space, constructing, building, investing, governance of a defined contribution system. It's a fascinating space. There's a global trend and shift towards defined contribution systems.
The big challenge of our time, really, as far as super is concerned, we're all living longer, is just how much money is locked up in the family home. Now, yesterday we spoke with your Household Capital CEO. You're chairing this business. What is the opportunity here? Look, the reality is you need time in the system, in the superannuation defined contribution system, and the reality is that those in their 50s currently coming up to or in retirement weren't in the system long enough to accrue an adequate level of saving. Because compulsory super came in, what, not so long ago? 3% in 86, 9% in 2002. So, look, if you came into the system 20 years ago, you're going to do very well when you retire in 25, maybe 30 years. But if you're retiring now, it's very modest, very, very modest. What we do know is that 8 out of 10 own their own home,
and the asset value of that home is $700,000 to $800,000, say in Sydney, whereas their super is only about $200,000.
Now, the big banks are pulling out of this space of reverse mortgages because of Hayne and because of responsible lending. So how can you move in?
Well, they're retreating to banking effectively, and retreating from anywhere that in the past, and certainly equity drawdown, reverse mortgage. There were bad practices pre-2012. It's now a very heavily regulated product, very heavily directly regulated. So those old bad behaviours have been removed from the system.
The challenge now, I guess, is to find a model that can deal with both those looking to supply these sorts of services and, of course, the customer.
Household Capital's approach is to present, at the point of retirement, you've got your superannuation account. What do I do with that? How much age pension, full or part, will I be eligible for? And I have an asset, my home. Should I access some of that to either top up my super and have a more significant income, some of that home equity, or you may later in life want to access that home equity, some of it, to pay for aged care or home care. I mean, they're typically the sorts of purposes you need some access to an income, whether it's via your super, which is inadequate for this group of people, or some access via your home equity.
And you're designing it in a way that you could actually take a lump sum out for something like kids' education even, providing it was for your overall well-being in retirement.
We're very much purpose-focused. So if it's to lift your retirement income via your super, that's a perfectly responsible process. If it is to carry out maintenance on your home, people want to stay in their home. Downsizing is a myth for most. They're not going to do it. They want to stay in their home. That's a legitimate purpose. If they want to pass something on to their kids, longevity, people, their children are generally coming up to retirement at the point when they're going to die. If they want to pass something on for a house deposit to their great-grandkids, funding aged care, purpose-driven. They're responsible purposes, but just spraying out a lump sum, Household Capital regards that as irresponsible, and we won't be doing that. Nor will we be distributing via a commission-based sell. That is not part of our business model.
Okay, so you've got, I think, $100 million credit facility from ME, who's got a stake in this startup. Is this the beginning of a whole new type of advice? You see others moving into this space?
Yes, certainly. I mean, there are two other providers at the present time. Our business model is significantly different in terms of the superannuation distribution advice approach. Look, I've got no doubt it is inevitable that individuals, to some extent, will draw some of their home equity for other purposes. I just think it's inevitable because the size of the asset, and it's inevitable not just in Australia, but it's inevitable in many other comparable countries. The UK is the classic, US, other countries where you've got the bulk of people have got relatively low savings at retirement through their super or equivalent, but also have a significant housing asset. It's inevitable.
I watched you last year at the ASFA conference in Adelaide talk about Kenneth Hayne and the Royal Commission and trust around super. How have both retail funds and industry funds come out of all of this?
Well, firstly, broadly, I trust the system. I trust the system. But what we do know, and it's the work of the Productivity Commission as well, their evidence, we do know that, look, there are a very significant number of people in the retail sector who are in a poor performing long-term product. Poor outcomes.
Often driven by high fees.
A whole lot of issues. That's one of them, but a whole lot of issues. We also do know, interestingly, that there are some it's a smaller proportion, significantly smaller in the industry public sector, because they're a not-for-profit, that are in poorer long-term performing funds. So the Hayne recommendations, I think, will significantly improve those circumstances. But I think you have to add the Productivity Commission recommendations. I don't endorse them, by the way, but I think solving two critical problems. One is multiple accounts. It's a blight on the system, so there has to be an automatic default mechanism to solve that. And secondly, removing the poorer performing retail funds. I think they'll remove themselves, frankly. I mean, that sector was restructuring before.
I mean, there's a lot of talk at the moment. I mean, industry funds obviously have more funds under management now than retail funds. A lot of talk this week about the role of activist investors pressuring trustees and indeed unions. What do you think of this issue, pressuring for things like wage hikes?
Well, the union issue, I think, is overhyped. I won't go into the detail, but this slogan of union funds doesn't exist. Yes, there are some trustees who are union officials on some funds, certainly not all funds.
Nevertheless, wealth inequality is one of the great issues of our time, and it may not come through unions. It may come through other activist investors that have been successful on issues like diversity and indeed on climate change. Should we be concerned because we know that trustees have this overriding obligation to put the member first?
Yes, well, yes, to put the member first and to invest for the long term. And if you're a smart trustee, investing members' money over we're talking about 30, 40-year time horizons here. You know, the Combe commentary is perfectly understandable. If you're investing long term, you've got to keep an eye on these long-term factors.
Like wealth inequality.
Like socially responsible investment, yes. Like wealth inequality, which is driving a backlash in a range of ways in our society, which I would argue undermines the capitalist system. So my central argument would be trustees should be keeping a very close eye on these factors.
So you'd put that up there with returns?
Yes, because if you don't, you're going to weaken the capitalist system. And I believe in a capitalist market economy that is working efficiently and effectively for all, for everyone. And I would argue a trustee has that fiduciary duty. But I think the greater challenge for trustees, many of whom I know in the industry fund land, is there are some industry funds that are poorer performers. And the critical question they should be asking at the moment is, given their long-term poorer performance, whether they should be winding up their fund. And I think that's the area where they should be focusing some
Well, the Productivity Commission came down hard on this, yes, and really pointed strongly to a whole bunch of egos.
Well, look, there are varying reasons, I think. Some level of nostalgia with the past, perhaps. But I would hope going forward it'll be a set of reforms, Hayne and the Productivity Commission evidence. I don't think the productivity 10 best funds will be implemented. But what my prediction is, we will end up with probably 10, 15 very large-scale industry public sector profit for member funds. I don't know how retail's going to settle. I mean, it's sort of a bit chaotic at the moment. There'll certainly be massive aggregation there. They'll have to transform the business models into much more efficient vehicles for delivering higher long-term returns.
But you see other competitors for industry funds coming in.
Oh yes, look, I think the bigger threats to everyone will be the really big global diversified trillion-dollar investment entities. We know who they are. With
it's a Vanguard going into super in Australia.
Very low fees. I mean, they are ideally suited to really give the current retail sector and the industry fund sector a real touch along, and really long-term global platform technology with diversified super cheap products that individuals will select could disrupt banking, insurance and super funds like we've never seen before.
Nick, after Hayne, after the Royal Commission, people think, oh, you know, why do I need financial advice? But I mean, you argue that the time that they do really need financial advice is on retirement, and you can see in future businesses like Household Capital and others actually moving beyond financial advice into advice on health and well-being as you age.
Absolutely. I'm not convinced you need personal advice prior to retirement, but I'm certainly convinced you need it at retirement. You've got a lump sum. You want to know how much age pension, part or whole, hopefully, and household capital's some level of equity drawdown. But I think you will have not just a super fund of the future, not just scale and good returns, and also obviously options in retirement for income, but they'll also add aged care and home care advice at those critical points in the 25, 30-year journey in retirement. And the really good funds, I think, will have that holistic approach. And my view is the funds that survive will have that holistic approach.
Nick Sherry, it's been great to catch up with you again. Thank you.
Thank you.
And that was Ticky Fullerton there, speaking to former Labor Minister Nick Sherry on the troubles in the superannuation sector. Well, time for a short break now, but after that we're going to be discussing populism, wages growth and international trade wars with the head of macro at Oxford Economics, Mr Gabriel Sterne.
This is Ticky on Your Money, covering the big business stories.
Welcome back to Ticky. Well, the Reserve Bank could be forced to take the knife to interest rates. Now, that's on the back of weaker than expected growth in GDP. Well, economists are now predicting at least one interest rate cut this year, now possibly before even the May federal election. Well, the issue could derail the Coalition's economic pitch to voters, and that's after the government warned Labor would wreck the economy if it's catapulted into government. Well, interest rates are already being held at the record low of 1.5%, but they could be slashed further amid concerns over cooling property prices and, of course, weaker than expected business investment. Well, the latest figures show that the economy grew just 0.2% over the last quarter, and over the entire year it grew 2.3%, which was down from 2.7% from the period earlier. Well, speaking of central banks now, former Bank of England senior manager Gabriel Sterne says that populism might be at the heart of consumer calls for wage increases and for greater public spending. Well, now he is head of macro research at Oxford Economics, and Sterne says that there's a populist in all of us and that the key to fixing working class resentment is to focus on inflation. Well, Sterne is currently visiting Australia, and I spoke to him from our Melbourne studio a bit earlier today. Gabriel Sterne, thank you for joining Your Money. Now, you've certainly picked an interesting time to visit Australia, at least on the economic calendar. Of course, we saw the final read for 2018 GDP just yesterday, and the economic growth rate of Australia has collapsed to 2.3%. The fourth quarter was just 0.2% growth, and most importantly, I think, our GDP per capita has now shrunk for 2 quarters in a row. It's gone back by about 0.3 percentage points. I'm just wondering, how much should we be worried about that?
Well, I mean, you should probably be worried about it, and me as a global economist, I'm very worried, because Australia's been a beacon of, defying the odds and consistent expansion for now, getting on for 28 years, the only economy in the world to have done so. So you're threatening the record books to end this, and personally, I think that Australia will get through this without a technical recession, so avoiding the per capita bit if GDP actually falls. But obviously it's running close, but I do think that the ravages of a recession via housing markets collapsing that we've seen in the past probably will be avoided, partly because your banks are in very good state, and partly because I'm not sure the consumption wealth effects are quite as big, maybe even as the Reserve Bank Governor has said very recently.
Now, just on the global economy, the OECD, of course, has also slashed its growth forecast for 2019. I think it's from 3.6 to 3.3 for this year, and they've also downgraded their forecast growth for 2020. Do you share their pessimism there for the global economy?
Well, look, if you're a macro person and you look at the indicators, the very latest, things are not looking good. Now, if you're in a markets person or you're really trying to look forward, I think the signs are looking a little better going forward. The first signs of the China policy stimulus are starting to come through. And of course, China is right at the centre of global trade and the global economy. So going forward, I don't see that 2018 has delivered, the bad news then has delivered a knockout blow in terms of something that's persistent, something that's going to keep the world economy going forward. So I would think that 2019 could actually be end of the second half of the year, things could start improving, and 2022.
Let's just turn now to some of the solutions to this global growth slowdown. Of course, in Australia, also around the world, certainly central banks have almost cut their rates to zero. So should governments be doing more to try to stimulate demand?
No, absolutely. I mean, the Fed and maybe even the RBA are some of the very few banks in the world that have a bit of ammunition in the interest rate locker, so that's there. But generally, I think the big question that we have to ask is, where's the inflation? Where's the inflation? And we're not seeing any inflation, and in spite of tightening in labour markets, I don't think we will. That means that bond yields are going to stay low. That means that government financing costs are staying low, and that means that I think governments all around the world, you know, can do more to stoke up their demand in their economy by, you know, potential infrastructure spending would be a great thing.
Certainly one of the things we saw in our national accounts was a fall in private business investment. So should we conclude that the period of ultra-low rates has really been a failure in terms of stimulating private business investment? Certainly it's stimulated a lot of household borrowing for homes, but not so much business investment.
Yeah, I mean, you've hit on one of the, it's the questions of our era, you know, not just of today. Why is demand so weak? Why don't firms invest? And in the end, I mean, they're not investing because the faith in the future of global demand isn't there. And that's due to, well, many reasons. But, you know, Larry Summers has mentioned secular stagnation, and I'm afraid I think there's something in that. So we're not very optimistic about the long run. You know, growth isn't ever going to go back to what we saw probably in the 80s and 90s. But, you know, it can be better than this, and that's probably why we need a bit more fiscal policy.
Well, certainly one of the other great questions of our era is sluggish wage growth, which we're seeing in Australia, which we're seeing around the world, and of course that is despite relatively low levels of unemployment. How do we fix that? The opposition leader here, you may have heard at the conference that you attended, he suggests that the government, by fiat basically, should increase the minimum wage from what is an already pretty high level of about $18.50 an hour. Do you see that as a sensible solution?
Well, I have to say that I kind of do. And I was very interested because coming from the UK, when the last people who were really big on increasing the minimum wage was Prime Minister David Cameron, who's not, you know, not a raving lefty by any stretch of the imagination. So I kind of think the evidence, you know, as an economist, what I want to know is, will a rise in the minimum wage possibly do a lot of damage to the labour market and to jobs? And there isn't much evidence for that, actually. And so I think that, you know, it surprised me over the years how little damage raising the minimum wage has done. But certainly one of the big risks around the world, not just Australia, probably more so in other countries, is the rise in populism. And, you know, one of the great causes of stability in the global economy has been labour market flexibility. But the flip side of that has been a rise in populism and inequality. So generally I think there's a case for, you know, high minimum wages.
Well, just in terms of that populism question, are you basically suggesting that governments may have to do things that are not conventionally sensible, but if they appease large segments of the voting population, that may actually be a good thing in the long run?
I think so. You know, it's a case of risk management in the world, and you know, we're short of inflation. You know, I think we've tended to battle the battles of the 1980s, but the new battles are, you know, we want more inflation. We need to stem the tide of populism, possibly by, you know, more fiscal spending, maybe raising central banks' inflation targets and things like that, and you know, recognising institutional frailties a bit more than we do before something really nasty happens.
Well, just on that question of inflation, surely though, if the rate of inflation shoots up, then workers' real wages will actually go down and they'll be even angrier. Can you guarantee that there'll be a flow-on to wage inflation itself?
Well, I see the logic, but I don't think it necessarily holds. It depends why inflation goes up. So, you know, if inflation goes up because wages have gone up, then, you know, wages do well. So I don't think it's automatic that just because you've got higher inflation, real wages goes down. You know, it really does depend why inflation goes up.
Now, just in terms of the populism issue, I want to ask you about Brexit briefly. I know you're at the Bank of England, I think, for about 20 years, so certainly lots of experience with the British economy.
Yeah.
Now, the Bank of England has been accused of releasing sensational modelling that are kind of scaring the population into not supporting Brexit. Do you think that any of those accusations are reasonable?
Well, you know, they presented scenarios, so you have to remember their scenarios. What I would say is that their scenarios were a little bit more pessimistic than Oxford Economics have been. So I think it's undoubtedly true that a no-deal Brexit would be very bad news for the UK economy. That even a Brexit under Theresa May's deal would be, you know, not worse for the economy than if there was no Brexit. But I think we're of the view that the Bank of England may have just over-egged it a little bit in terms of the implications.
Now, just in terms of that no-deal Brexit, the deadline, I believe, is the 29th of March, which, of course, is only a few weeks away. Do you see the prospect of a no-deal Brexit as fairly likely then?
Well, we as Oxford Economics think there's around a 30% possibility. The reason it's not higher is that, actually, if you look at the numbers in Parliament, there's 650 MPs and 50 support a no-deal Brexit. 600 don't. So my opinion, you know, at the moment there's a lot of tactical plays going on, which are mainly involve inflicting damage on the other guys. You know, that's Labour's main motivation. But when it comes to it, when you stop behaving tactically, you start behaving strategically, I think you rally around a deal. Nobody particularly likes Theresa May's deal, but maybe it's the best we're going to get.
Well, still on the broader issue of trade and, of course, the ongoing negotiations between China and the United States, it seems like there's going to be some sort of deal. Is that also your assessment too?
Well, that's a very broad consensus. Now, you know, trying to second-guess President Trump's agenda is not something that me as a macroeconomist is particularly skilled at. But I do think that the tea leaves are there, the incentives are there for Donald Trump to try and get something he can claim as a victory. So, and what I would say is that it's been a shadow overhanging the world economy.
Is it possible?
And that it would be a very good thing if this was removed.
Is it possible, though, that some sort of deal between those two countries could actually be bad for third parties like Australia if China is forced to buy raw materials from the US rather than from us?
So in the short term, you can imagine that scenario. My view is in the longer term, these things tend to work out, and you know, if the US or China trade more with each other, it shouldn't affect world prices on a sustained basis. You know, industry is clever and smart and usually manages to find another client. What really matters in the world is the overall level of activity, and these diversion of trade flows and bilateral don't make a difference in the long run.
And just finally, Gabriel, to be in the Reserve Bank of Australia's shoes at the moment, there's a great deal of pressure for them, increasing pressure for them to cut rates later this year. Do you see that as a sensible policy move, given that, as we discussed earlier, previous rate cuts don't seem to have stimulated too much business investment?
Well, on the other hand, you don't know what the counterfactual would have been if they hadn't have done it. Well, I mean, I think as a central banker, now I view it as a risk management issue. If I don't think there's much inflation in the world, then the potential damage from lowering rates isn't that big. And, you know, I think the Australian housing market is... The economy is fairly well insulated from the housing market, and the banks are in good shape. You know, some young people actually would probably welcome a bit of a fall in house prices, so I don't think the wealth effect is going to be enormous. On the other hand, it's not obvious that the economy is heading so far into recession that they need it. So I think our base view would be that probably a flat path is sensible, but, you know, certainly I think a rate cut is worthy of serious consideration by the Governor.
OK, Gabriel Sterne, thank you so much for joining us.
Thank you very much.
And that was Gabriel Sterne there, talking about his outlook for the global economy and the Australian economy too. Well, time for a short break now, but after that we're going to be considering the question of what would Australia's tech sector like to see in this year's federal budget. Well, Ron Gauci, CEO of the Australian Information Industry Association, he joins us next.
Now, back to Ticky.
Welcome back to Ticky. Well, the Australian tech sector will be looking very closely at R&D policy in the upcoming federal budget. Now, this is after many in the industry complained last year about changes made to the R&D refundable tax offset, which has been capped at $4 million. Well, the changes hit a roadblock earlier this year with the legislation to be put on hold pending a policy review. So what R&D changes will the tech sector be looking for in this year's budget? Well, on that, I'm pleased to welcome Ron Gauci, CEO of the Australian Information Industry Association, live from Melbourne. Ron, thank you so much for joining us. Look, certainly this is a government policy which is constantly tampered with. Why do you think that is the case?
Well, it appears that the intention of the legislation is to manage the governance and compliance issues instead of actually acting as a motivation for innovators to seek an R&D path. So I think the intent of the legislation has got it all wrong. We're trying to resolve a problem that isn't really a problem.
Now, certainly there was a perception years ago, I do remember, that the credit was being used by large businesses, you know, basically as an offset for expenses that they would have committed to anyway. Has that problem been fixed?
Well, all the research and all the papers that have been provided to the government indicate that there isn't really an issue. And even if you did have an issue, but it's not, but even if there was an issue there, the reality is organisations will always look to optimise their tax rebates and their tax position. And right now, the legislation is creating issues for us because whether you're in the small, medium end of the business or the large corporates, they're looking for the best possible deals around tax rebates and tax benefits. And right now, it's not in Australia.
Now, just on the tech sector in particular, I mean, I assume that's a big user of this particular offset?
Correct, although we're on by world standards, we're actually falling well and truly behind. So it depends on which report you look at. We've, in terms of the investment around R&D, we've fallen back to either 19, 20 or even outside the 20 percentile of large countries and large economies, that our investment has declined some 12% in R&D over the last few years. And we have an issue with that because all of the other reports, Bloomberg I think recently spoke about the most advanced economies, the ones who invest in R&D, and because we've fallen down the ladder significantly, we're not going to be competitive on a world scale. And the reality is that economies that do invest in innovation and R&D are the ones who are showing the most positive impact at this point in time. So we have a real concern that we're going to see a brain drain, we're going to see talent move offshore, we're going to see innovation move away from us, and even large organisations decide to conduct its businesses elsewhere.
So just in terms of R&D policy more generally, what should the federal government do in your view? I mean, I presume that you think they should expand the offset, but should they do something else as well?
Well, I think it stems from how the legislation came to be in the first place. There wasn't a great deal of consultation. And I think if there was a degree of consultation, we would have influenced the thinking around simplifying the legislation, simplifying the process to apply for the rebates. We also have an issue with the legislation at the moment. The bill creates all sorts of levels and complexities which we think need to be simplified, and that there's criteria from which you can apply for the rebates, and the assumptions behind the criteria and how it is the criteria were ascertained don't seem to be pertinent to what the industry requires. So we're recommending that we go back, have the conversation. We're working with Oz Industry. We're suggesting that we review the legislation. We talk about how we could make it more practical and more implementable for small to medium enterprises, especially having that 4 million thresholds for organisations under 20 million makes it almost, I won't say impossible, makes it very, very difficult for them to apply for those rebates.
Now, just in terms of the differing views of the major political parties, are there sharp differences between the Coalition and Labor on this issue?
Well, I think this is part of our frustration at AIIA. We're not getting clear direction from either side of the fence in terms of how we're looking to promote the ICT industry. If you look at our industry as it is, we're one of the fastest growing industries in Australia. We have the potential, if we get this R&D component right, again, the government has access to these reports, in the next 10 years, we could actually generate $315 billion worth of value to our economy. We have a shortage of some 200,000 jobs. That is an employment or a skills opportunity. We as an industry are saying we are more than happy to enter the retraining marketplace to assist with that. We see significant opportunities for innovation, and yet on either side of the fence at the moment, we're not actually getting any clarity in terms of where the investment's going to come from to support and promote the ICT industry. We've got significant innovators within our economy that are producing some terrific opportunities, and we've seen successes offshore. We ourselves as an organisation, through vehicles such as our AIIA Awards, which have been running 25 years of great innovation, great expertise, young innovators coming up with ideas that are playing significant parts on the global stage. And yet, neither side of the House, whether it's the opposition or the government, has had a clear strategy on how we're going to promote further growth in our industry.
Is it partly, Ron, a political issue in the sense that the perception there might be that large swathes of the population are actually scared of innovation? And I just point to the 2016 election when a former Prime Minister Malcolm Turnbull actually ran on a campaign, if you like, largely of growth and innovation, and of course he almost lost the election. Do you think that that's kind of scared off the political class a bit about talking about this stuff too much, because it could be seen as a job destroyer?
No, it's a great question, Adam, because the reality is we all love innovation. We all enjoy seeing the benefits of it. If we go back a decade and have a look at the innovations that impacted us agriculturally, whether it's agriculture, sport, our economy, education, health, innovation has had a major impact across all of those industries. We should, our GDP, if you take this figure there, the ICT industry contributes to 7.4% value to our economy. Most developed countries have a figure of in excess of 11.2. If we actually look at growth in our industry, we could provide significant benefit to our economy, and as consumers, we are all the beneficiary of innovation, and we all enjoy it. Look at the significant number of technologies that we come into contact with and we take advantage of as consumers. I also think if you look at the heart of our small to medium business, which is the heart and soul of our membership base, again, there's significant innovations that are being worked on that they need support. They need the support of government, the corporate environments, AIIA. We as organisations are there to support them. I don't see any sense of fear, as you're suggesting. What I see is a frustration.
Okay, Ron, we do have to leave it there, but thank you so much for joining us. That's Ron Gauci there for the Australian Information Industry Association. Well, that brings us to the end of the show. That's all for tonight. But, of course, tomorrow is International Women's Day. And fittingly, Ticky will be back in the chair and she'll be speaking with the editor of Vogue, Edwina McCann. Thanks for your company.